We're going to get started. Thank you all so much for coming. We're super glad to see you here. I'm Jocelyn Kennedy. I'm the Executive Director of the Harvard Law School Library. I just want to let you know a couple things. Copies of the book are in the back of the room for sale. I think the authors are going to stick around and sign books if you'd like a signed copy. I also want to let you know that today's panel is being recorded, and the recording will continue through the question and answer portion of our conversation, and it'll be available on the Law School's YouTube channel next week. And to start us off today, I want to introduce our moderator, Nell Minow. Ms. Minow is a columnist for the Huffington Post, where she writes on a wide range of topics, from film, which is super fun, to public policy and corporate governance, which is super fun to some of us, but maybe not all of us. She's an editor for Minovere Press and is the vice chair of Value Edge Advisors, which helps institutional investors engage as owners with their portfolio companies. And Ms. Minow is going to introduce the rest of our panelists, so I'll turn it over to you. Thank you so much, everyone, for being with us today.
Thank you very much. We know who our true friends are, the people who came even though we're not feeding you. So thank you very much for being here. And it's a pleasure to be here at Harvard, where both of my sisters are in residence. My one sister, the dean of the law school, my other sister, a participant in the ALI program. So thank you. We've got a terrific panel today. This is really my dream team panel. I've worked in the field of corporate governance for more than 30 years, and there is nobody that I hold in higher esteem than the two authors, the two of the three authors of this book who are here today. We've got Stephen Davis, Associate Director of the HLS Corporate Governance Program, and a co-founder of Governance Metrics. And Jon Lukomnik, also a co-founder of Governance Metrics, which later merged with my company and was later sold, and also the head of the Investor Responsibility Research Center Institute, which does really, really important, thoughtful research and analysis and webinars about corporate governance issues. These guys are absolutely the top, and I'm very excited. I love this book. I'm very excited to hear what they have to say about it. When I first got into the field of corporate governance, as I said, more than 30 years ago, my business partner, Bob Monks, a graduate of Harvard and Harvard Law School, said to me, when I explained that I didn't know anything at all about corporate governance or corporations, having spent 8 years in government, he said, read Bob Clark's book right now. And you couldn't have a better introduction than that. Bob Clark, former dean of the Harvard Law School, is absolutely the best when it comes to understanding the history and theory of corporate law. And then Bob Eccles from the delightfully named Arabesque Money Manager is an expert on transparent reporting, sustainable value creation. And so what we have here is a group that can talk about these issues from the perspective of the customer, that's the shareholder side, from the theoretical and historical side, and from the money manager side. I want to say just a couple of words of introduction before I turn it over to Stephen and Jon, and I want to set a framework. Here's what the problem is. The problem is that we give our money to other people and expect them to do a good job with it. Whether we're buying stock directly or we're giving our money to money managers who then buy stock, we're entrusting our assets, our future, our retirement to other people. And if you are an economist, you call that agency costs, or maybe a moral hazard. If you're a lawyer, you call that conflicts of interest. But the question is, the unanswerable question is, how do you get anyone to care as much about your money as you do? And that's what we try desperately with the structures that we create, the legal standards we impose to solve. Problem number two is, even if you do owe this important duty, even if there is some way to monitor, who is enforcing that? Well, we have a shareholder community that is so dispersed that it is almost impossible for them to exercise any kind of oversight. It's the legendary separation of ownership and control. And again, going back to economists, they call it the collective choice problem. The amount of energy and resources that you would have to spend to exercise oversight is in excess of anything you could possibly gain. When I went to law school at a different law school somewhere in the Midwest, we had a professor, now Judge Posner, who used to end every class by saying, of course, all of this assumes perfect information and no transaction costs. And I think what the crux of this wonderful book, which if I could recommend one book to everybody who's running for office this year, this would be it. The crux of this wonderful book is what happens when we don't have perfect information and no transaction costs. What happens when we have enormous transaction costs that are not revealed and no ability to discover them or to take your business elsewhere. So with that as my overall introduction, I'm going to turn it over. Who's going to speak first? You, Stephen? To Stephen, and he's going to tell you a little bit about the book.
Well, thank you, Nell. It's great to be here, and also really honored to have you chair this. I know that your sister, Nell Minow, wanted to be here, and she couldn't. I also know that she is very intent on making sure that Harvard Law School is ahead of the pack when it comes to research and thinking on corporate governance, because if she doesn't, she knows that the conversation around the Thanksgiving table will be tricky. So I know that. So we do a good job here, and I'm really delighted also and honored to have Bob Clark and Bob Eccles here today as well, and I know that we'll learn a lot from their conversation. And I know that Jon will speak after me. I would just make one comment, which is that we also have a third author. There are three authors in this book. David Pitt-Watson is the
I noticed
third.
Nell said we were her two favorites.
And he's based in London and was not able to make it today, but sends his best wishes. So I'll just make a few comments about the book, and I would just start by observing that, as we all know, there is a vast amount of kind of free-floating anger in the nation against Wall Street. It's not just in the United States, it's elsewhere, but it's clear that Wall Street is a target in this presidential campaign, general election campaign. You only need to watch and what's gone viral is the 17 minutes of Elizabeth Warren grilling John Stumpf, the CEO of Wells Fargo, before the Senate Banking Committee a couple of weeks ago, to realize how deeply felt this issue is. I mean, Wells Fargo happens to be sort of a gift to our book, as it happens, just because it happens to highlight so much of what has gone wrong in the financial system, and we can talk a little bit about that. But those 17 minutes really give you a sense of the kind of dismay that it has spread across the country. Wells Fargo just being the latest sort of poster child that people are focused on. But part of the reason why we have reached this moment is because our financial industry is no longer fit for purpose. And I say that by reference to, for one thing, an important study that was done by an economist, Thomas Philippon. Jon will talk a little bit more about him, and his research. But one of the things that he observes, looking out over 130 years of the history of finance in the United States, is that the cost of capital, the cost of borrowing, of transactions, has been the same for all these 130 years, despite innovation, despite modernization, the invention of the telephone, ATMs, everything. The amount that we pay, each of us, for moving capital from one place to the other is the same, even though there's been enormous progress in other fields to reduce transaction costs and increase efficiency. There's been no real increase in efficiency in the finance sector. And yet we know, with ATMs and other things, that there has been innovation. So the question is, who has captured the benefits of innovation? And the answer is, if we look at it, it's really the finance industry itself. It's not, in other words, ordinary people, as Nell was talking about. We are all capital providers. All of us, or most of us, if we're lucky to have a 401k or a pension plan, we have money that is somehow invested in the marketplace. And it is invested by institutions. And the question that has arisen is how those institutions, how have they managed that money? Have they managed it in our interests? Or have they become further and further divorced from our interests? And have we, in effect, enabled them to do that? I'll give you an example that we talk about in the book. We sort of imagine triplets. One in the United States, one in the UK, one in the Netherlands. Each the same age, working the same lifespan in professional business, and retiring at the same age, and saving each year the same amount for their retirement. At the end of that period, the saver in the Netherlands will have a nest egg 50% larger than someone saving in the United States or in the UK. It's as much as 50%. And the reason is because of fees, for the most part. We have a system where, if you generally pay, and there are a number of different fees that people pay, but if you're paying a fund, say 1.5% a year to manage your savings, you're going to, and that, let's say, compares to the low cost, which is 0.2%. You'll end up with 38% less at the end of your working life. If you're giving a fund 2%, you wind up with 50% less. And for the most part, people, ordinary folks like us, we do not realize that we are every year allowing our agents, in effect, to siphon that kind of a tranche from our nest eggs. And by the way, it's not just in the United States. I mean, we note that the Netherlands has a particularly effective system for retirement savings, but there was a report that just came out the other day that looked, I was just noticing it yesterday, looking at Belgian pension systems, and they show that in 16 years, someone saving would see a nominal performance, that is what they think that the stock market has sort of brought them, of 100%. But the real performance that they will be getting, in other words, what the real value if they wanted to cash out, would be 44%. And the reason is because of fees. The reason is because of fees. And the issue is that we're allowing that mainly because we don't know very much about it. If you are a typical saver with a 401k, you can today, call up on your screen a sort of a register of where your money is being held, what stocks are in the portfolio, where the trades are. But one of the things you can't find out for the most part is how much you're paying for that. What are the total fees? The total fees. And it's just simply very difficult to find that out. And by the way, it's not just difficult for individuals to find that out. It's difficult for big institutions, even the pros. We have an example of a group called Railpan, one of the largest pension funds in the UK, that was a little concerned that they also didn't have a handle on how much they were allowing or paying out to their intermediaries, their agents, for managing their money. And they did a study. They actually had to hire somebody to figure this out. And what they found out was that instead of paying what they thought, which was £75 million for a £20 billion portfolio, turns out they were paying actually 4 or 5 times more than that, not 75 million pounds, but 290 million pounds. And again, they simply were not aware of it. So what we have is an absence of information, and that has allowed the finance industry to extract an excessive and perhaps disproportionate amount for itself, really without our knowledge. And what that also means is that funds tend to be divorced in other ways from our interests. And we show a number of examples. One, for instance, is we expect our funds not only to maximize our value for the long term, for our savings and whatever we're savings for, retirement, health care, housing, but we also expect our agents to act on our behalf to protect against risk. So, for instance, if a company like Wells Fargo has exhibited certain risks, you expect your funds to act against that. But if we look, again, just at Wells Fargo as one example of this, every year for the last 10 years, actually more than 10 years, there has been a shareholder resolution at the annual meeting of Wells Fargo asking for the company to split the chairman and CEO jobs. And we know that there has been risk at Wells Fargo. It's been obvious since at least 2013 when this cross-selling scandal was first revealed. But despite that, funds, the large funds such as Vanguard and BlackRock, which are the two largest funds at Wells Fargo, have voted consistently against splitting the chair and CEO. So the question is, has that been in our interest? And to step then back a little bit to see how are funds acting as owners on our behalf, you really have to ask whether they're doing the job that they need to do. We have an example of one fund that devoted resources to hire one person to vote shares at 10,000 companies. Vote shares at 10,000 companies. So that, by the way, is a fund that advertised itself particularly as one which looks after the interests of the little guy. So it's hard to imagine that kind of resource devoted to ownership of the market is truly aligned with the interests of, as Nell was saying earlier, how are we expecting our agents to look after our money? In effect, our people, all of us, have been separated from our capital. Ownership in the marketplace has been hollowed out. And how then does a market function well? And why do you not see even more Wells Fargos happening? So the question is, what do we do about it? I'll just mention a few solutions that I think we would propose. And one is that while we have spent the last couple of decades focusing on the improvement to boards of directors, and they are enormously better than they were 20 or 30 years ago. We've spent lots of time on that. We have made them much more accountable to institutional investors, which may be a good thing, except that we have then not spent the time looking at institutional investors. How accountable are they? How transparent are they? How aligned are they with their ordinary savers like us? That's an area that we've spent very little time on, and my feeling is that is the next phase of capitalism, is really to make sure that institutional investors are themselves accountable. Because if you think about it, the same institutions that ask companies to do all sorts of things in corporate governance, if you asked them, could they meet those same standards, most of them really could not. And so we need to focus on that. One of the ways in which that could happen is if we call on our institutions to disclose what we call the financial equivalent of a nutrition statement, so that every year you could see and be able to compare one fund to the next, not just in what kinds of investment philosophies it has, but also what kind of an owner is it? What about its own governance? How transparent is it? So a nutrition statement would be one way of bringing progress. Another would be, right now, as I mentioned earlier, it's very difficult for anyone to find out how much they pay in fees. Well, we should move to a situation where the ordinary saver could call up on the screen not just what stocks they hold and what transactions recently took place, but also how your fund voted in real time at Wells Fargo and all kinds of other companies, any company in your portfolio. So you should be able to tell how your ownership is being expressed. So both fees should be made obvious, and also voting decisions should be made obvious. And then the third, and I'll move on to give the floor to Jon after this, is we need a change in our fiduciary duty standards, because right now it is the case that many funds still adhere to what would really be considered at this point obsolete standards, where you should not look at environmental or social or other kinds of risk factors when we know that those risk factors do play a role. So fiduciary duty should be able to incorporate that. The final point I would make is that we've noticed that there's, whether we agree with them or not, there are picketers outside. And there's a strike going on, and the reason why is that there is a union that represents workers in our catering industries here. We don't, in a way, have an organization in the United States that speaks out for ordinary savers. We have lots of institutions that speak for the financial industry, but we don't really have those that are speaking out for ordinary savers in the same way or a similar way to how a union might advocate for employees. So in a way, that's probably the next phase. If anybody wants to start one of those, please let me know.
So we're going to turn it over to Jon first. I want to quote one of my favorite lines from the book to underscore what Stephen just said. Worker savings are a virtual ATM for the financial services industry. And they've got a wonderful section of the book that describes 16 different people with their hands out, basically taking a toll between you and the money and your money. So there's 16 different, that they've been able to identify 16 different little bites out of your money on the way. So I'm going to turn it over to Jon.
Thanks for mentioning the 16. Stephen had already said everything I want to say. Now I have nothing left. I want to go back over some of the things Stephen said, but from a totally different viewpoint of what the impact is on society and the economy. Stephen spoke a lot about what it means for you and your 401k and for individuals. So I have a little parlor game. I play it when people come over to my house who are out of the business. I say, what's the purpose of the financial system? What do you think the answer I get most is? Anyone? They'll say, make money. Well, making money is not a purpose. I mean, a restaurant makes money. Book publishers don't, but that's a different issue. But you know, the person made this pen makes money, the tailor made money, right? You need to make money. There's nothing wrong with it. I am a dyed-in-the-wool capitalist. But it's not the purpose. And too many analyses of what's efficiency and what's not has to do with how the intermediaries in the financial industry make money, right? There are multiple purposes, from safekeeping your money. You know those little ridges on the edge of the coins of a quarter? The reason they're there is because when coins used to be made out of gold and silver, unscrupulous banks would shave it a little and give it back to you. This way you could tell that they hadn't been shaved, right? So safekeeping, we take that for granted. Risk sharing, insurance. There are payment systems. There are a lot of purposes. But as Stephen said, the most important purpose of all, the thing that drives our economy, is something that economists call intermediation. And all that means is, as the third Lord Rothschild once said, as Stephen said, taking money from point A, where it is in the society, all your savings, to point B, where it has to go in the society, and investment in a new plant, equipment, a new Silicon Valley startup, whatever it is. And that is what drives our economy. And the cost of intermediation has stayed at 2% since the age of the railroads. Stephen said we invented the telephone. We've also invented the computer. We've gone to the moon. Everything else has gotten more efficient. And so the question is why, and what's the impact of that? If that 2% were 1%, and I am making some heroic assumptions, so any economists in the room as opposed to lawyers, yes, I am holding everything else static. If that 2% were 1%, our economy would be growing 20% faster just this year, right? That's not even counting what would have happened with the efficiencies over the last 130 years, which would have given you a higher base, okay? So this is really important stuff. And too often when you criticize the finance sector, you're not a capitalist, you don't believe in business. No, I deeply believe in it. And I want to do what we do to every other business. I want to make it better and more efficient, right? If Apple earned a nickel next year instead of the billions of dollars, it would still be a profitable company. But no one would say, how dare you criticize them? You'd say, you could do better, and we can do better. So the question is, why? By the way, fueling anger, that 2% fixed, the amount of the economy that's been intermediated over the last 130 years has gone from 2% of the economy to 8% of the economy. So 8% of the economy gets financed in some way, shape, or other by, let's call it Wall Street. The inevitable result of that, right, increasing times fixed, 1 out of every $12 in the United States economy is Wall Street. If you want to know why people in Des Moines are angry, it's a very good reason. 1 out of every $12. So why? Nell mentions 16 intermediaries. There are an increasing number of intermediaries. Each of them gets paid. To be sure, they do a job. But the question and the amount of the efficiency between intermediaries has improved. But the multiplication of intermediaries, there's a transparency task force in the UK that's identified 200 different fees. I work in this business. I find new fees all the time. I mean, there are fees on global investments that you would have never heard of, like the Bank of New York charges you if you own stock in a Russian company through what's called an American Depository Receipt to go and inspect the share register in Russia. Probably a good idea, but they also charge you to process the dividend. They also charge you for sponsoring the ADR, and by the time you're done, it's 2% every year on a share of stock, right? So I just found those out this year. I mean, when Stephen says you don't know the fees, I saw people go, yes, I do. I can see that I pay 54 basis points for a stock fund or something. That's just the tip of the iceberg. You don't know the trading costs. You don't know the spreads on bonds. You don't know the hidden fees that are inside there. So each of these intermediaries adds fees. In the UK, they've counted 200 already. I'm trying to count them in the US. They're a little hard. I'm up to somewhere around 100. Right? It's frightening. And what happens is, because of this profusion of intermediaries, much of the financial transaction takes place between each other. And it totally perverts the system. It does it on a top-line basis. John Kay is a wonderful British economist. UK banks, on a dollar basis, do about $7 trillion of lending a year. $5 trillion is to other financial institutions. Only $2 trillion is to what he would call companies that do things. Right? A little negative on the finance industry, but that's John's phrase, not mine. But if you think about it, what that means is you're paying $7 trillion worth of fees If the purpose is from point A in the real economy to point B in the real economy, $7 trillion worth of fees on $2 trillion worth of real economic activity. No wonder it's expensive. The chain of agents does attenuate us from our ownership. It creates these misalignments where you do things for the next agent in the chain, and you think you're doing your job because that's the person you talk to. That's the person you have a contract with. That's the person who's the next in the chain. But if you measure it from the real economy to the real economy, it has real misalignments of interest. Partially because those agents are transactionally paid. They're interested in short-term things. Some of the longer-term issues, innovation, sustainability, climate change, things which are both opportunities and risks, that's not how agents get paid. That's how you and I investing for retirement, kids' education, mortgage, which have long-term get paid. They don't. The entire business model is we beat the other guy in investing for this quarter. If you think about that, that really is a sprint, and sprinters don't make good marathoners. They just don't. And examples, high-frequency trading, right? Controversial. There's all this argument of does it add liquidity to the marketplace or not, and therefore is it more efficient? But they're asking the wrong question. My personal belief, by the way, is it adds liquidity to large cap stocks during normal markets, which when you don't need it. But that being said, even if it did add liquidity, it adds liquidity for people who are pricing stocks 3, 4, 5,000 times a minute. Does that do anything for the real economy? It adds costs. It adds obligations. It doesn't. It's secondary trading that doesn't do anything for the real economy. Another example. Anyone want to take a guess at how many mutual funds there are in the world? Throw out a number, someone.
600,000.
600,000. Wow. Okay. Well, you're the only person who's ever guessed high. 79,669 at last I counted.
Okay.
Right? I'm sure it's changed, but there's no reason. There is a reason. If you randomly start that many funds after 5, and you just assume half of them will be better than average 1 year and another, and half of those or a quarter will be better than average. By the time you're done in 5 years, right, some number of those will have great track records. It's a great marketing scam because you don't think about the ones that were started and you're not looking at. You're looking at the one, it's got to be skill. I'm going to invest in that one. But what it does is it decreases economies of scale and adds costs to the overall system. So there, again, it favors the agents. Wells Fargo really is the gift that keeps giving. It is a great example of what happens when you forget your purpose to serve the real economy. I'm not going to go through the whole scandal, but suffice it to say they had aggressive cross-selling goals which contributed to it. The average in the industry is about 3 accounts per person. They had 6.27. They were very proud of that number. The fact of the matter is that there was no incentive to say, does the person need this account? In fact, obviously they didn't, because they didn't start them. They were phantom, and they were never told they were starting them. They just started them without even telling you, and then took your fees and then closed the account, and you never knew it happened. Right? So you have a misalignment of purpose because everyone's trying to deal with the next agent. In this case, internal to Wells Fargo agent. The bank officers were trying to please the branch managers, who were trying to please the division managers, who were trying to please the division president, who, until all this exploded, was able to retire with a $124 million bonus because the CEO of Wells Fargo didn't want to make a stink. So it really is an important industry. It doesn't provide food or shelter or clothing, but none of that would exist at the scale we need without it, without that intermediation. So if we can get that cost of intermediation down and grow the economy faster, that would be a wonderful thing. Now, I do want to, The subtitle of the book, I think, is important. How the financial system fails us and how to fix it. Now, it takes a certain amount of nerve to take on the whole financial system. It takes even more to suggest how to fix it, right? So, Stephen mentioned some of those. I want to mention a couple of others, and then I want to end with a why I think it could happen. There is no one big fix. We are not proposing, if you had brought, if you separated banks and commercial banking, it would all solve everything. No, it wouldn't. No one thing will solve it. Stephen mentioned transparency of fees and fiduciary obligation. That would be a way to let the market start reining in all these agents, to say, okay, I'm at point A, I can see point B, why do I have to pay all these people, all these 16 agents along the way? And they'd better act in my best interest, not in the best interest of the next person in the chain. Technology. In some ways, San Francisco is attacking New York. Silicon Valley is taking on banking. Steve and I were just at a meeting last week in which we heard a vice chairman of Travis Laster, the Delaware Chancellery Court, talk about using blockchain technology to distribute proxy voting. I've also heard about it to distribute letters of credit to reduce costs. In the past, whenever there's been a technological solution, finance has been so much bigger than technology, it has co-opted it or regulated it out of existence, or regulated it to a fee level that it was useful for finance to own. It's unclear whether they could do that this time. Technology is pretty big. We'll see what happens. Self-action, institutional investors. You have tons of institutional investors who have signed things like the Principles for Responsible Investment, who then go and hire managers who work on a quarterly basis. If they would change their contracts, if they would exert pressure, Stephen mentioned that BlackRock and Vanguard voted against separating the chair and CEO at Wells Fargo for years. I know of a couple of large asset owners who are going to call Larry Fink and say, excuse me, next year could you do something different? They didn't do it until now. Maybe it'll change things. Corporations. There's a whole section on executive comp. In my mind, it is the most over-discussed issue in corporate governance. It may be the most important, but it's also the most over-discussed. But clearly, our executive compensation is geared towards a 3-year short-term cycle. It takes longer than that. Most companies have no line of sight into future value creation metrics that either deal with sustainability or even product development. I mean, think about the fact that the average CEO has a tenure, I don't know what it is right now, but it's probably 4 or 5 years. It took Apple 7 years to develop the iPhone. Right? Steve Jobs didn't benefit from that. Tim Cook's benefiting from it. Right? The question is, how are you paying people? If you're paying them on share price, that's subject to the vagaries of the market, risk on, risk off trades. You're not creating value. You're paying on a chimera. And by the way, if you pay people in a currency that goes up and down in the marketplace, it's not surprising that they're going to look at what the marketplace is doing and deal with that. So there are ways that companies can do. There are some 80 fixes in here. I just want to say that we do, in fact, try and talk about fixes, and we've had some nice response to that. Finally, I want to leave you with why, despite all this, I'm optimistic. Right? Because reporters keep asking us, oh, this is great, it's never going to happen. How realistic are you? Right? So I call this an aggressively centrist critique. Because really what we're trying to do is use 21st century techniques to return to some old concepts: common sense, ownership, fiduciary obligation, rational economics. So what I find fascinating is when you actually point out the emperor has no clothes, other people get it. Early in my career, I was a young aide to a guy named Harrison Golden, who was a legendary figure in New York City politics. He saw New York City through its fiscal crisis. I realize most of you don't, that's ancient history. He was also, and for this purpose I want to mention it, the investor of the New York City's 5 pension systems, which was a role I later had under one of his successors. At the time, it was the 1980s. And again, ancient history for some, but let me set the scene. The 1980s on Wall Street was the 1880s in the Wild Wild West. I mean, it was colorful semantics. It was the year of raiders and white knights and Pac-Man defenses. But most of all, it was the year of green mill. For those of you who don't know what green mill is, it was the Wall Street equivalent of blackmail. I was a raider. I went into your company. I said, I own a chunk of your stock. Unless you pay me more than the market price of this company, I am going to have a hostile takeover and make your life miserable. And what happened initially was all the managements, and to some extent the boards, which, as Stephen said, have improved since then, but back then were somnambulent, said, sure. And everyone was happy. The raider made money. The CEO lived to rule another day. The boards weren't disturbed. Everyone was happy except people like my then boss, Jay Golden, who was investing money for teachers and clerks and firefighters, and said, hey, you guys, I said, wait a second. You just spent our money so that you could have a life. That's not fair. This wasn't small change. I mean, James Goldsmith greenbilled $93 million from Goodyear. Walt Disney paid Saul Steinberg $60 million. By the way, that was after Steinberg had already greenbilled Quaker State and Penn Central that year. There were $4 billion paid to make green billers go away in 1994, and that was $1994. Okay, $4 billion just to go away. Everyone was happy except for savers and fiduciaries for those savers. So Jay, along with 2 of his compatriots from California and New Jersey, started something called the Council of Institutional Investors, which still exists, to fight for cleaner markets. And basically, we all said to the managements whose shares we owned, if you do this, you will soon be an ex-CEO. It is unfair to use our money to pay green millers to go away. And it stopped. I mean, it's amazing when you think about it. It actually did stop. You do not get green mill anymore. And in the end, that's what you do with your money is all about. It's our effort to improve the world through the financial system. And the financial system just happens to be really, really important, so we should care. That's why I think it's important to do this.
Great. I'm looking forward to hearing what our commenters have to say. Bob Clark, would you like to weigh in?
Sure. I could just say, I could just channel my friend Dave Swenson in his review of the book and say, in effect, it's an extremely readable book, everyone. That's why you get it. It identifies real and serious problems, and it offers general principles, not really sharp blueprints usually, but general principles for improvement that are pretty sensible. So I could just stop there, but I'm a law professor. Law professors like to worry and identify complications and problems. And so what I want to say is basically, I think there's plenty of room for a sequel book, a version 2.0, that would deal with some other issues more elaborately in a complicated way. That is, and it's mostly, I think we need to get a really full analysis of the behavior and psychology of not only investors and agents, intermediate agents, but also of ultimate savers and individual investors. As a trustee of TIAA, the giant nonprofit investment firm that does money for, invests money for the academic community mostly, I have observed the behavior of managers of that nonprofit firm and how they tend to be tempted into thinking differently than the nonprofit mode. And I've observed the behavior of my colleagues on the board, and even more importantly, talked to dozens, many dozens of faculty members, administrators, and secretarial staff over the years about what they do with their retirement money. what has impressed me about all this is conscious bad behavior or conscious foolish behavior is fairly rare. It does happen. There are bad people. Most people think they're doing something wise. Or to put it another way, there's a shout out in the book, a proper one, to the importance of designing the system in terms of behavioral economics. I would put the point more in terms of, well, we've got to take account of evolutionary psychology, our innate evolved dispositions, and how they can go wrong in the modern world. Or, I'm a former seminarian, so I think this way. We could go back to the Buddha and his writings, or the writings of medieval theologians, and talk about what I would call the 7 deadly sins of our innate psychology and how they affect our behavior in this space. That's actually more than 7, but I like that number. So what would we have in version 2.0 of the book? Would have some analysis of the traits that people have that lead not just the intermediate agents who populate our investment system now, but the ultimate savers. They're both affected by all these traits. I'll mention the 7. First, we all tend to, well, many people tend to have an overconfidence bias. That's why we have so many individual investors who are active and think they can do a little research and beat the market by individual stocks instead of a diversified portfolio. Wrong, probably, most of the time. Second, we have a confirmation bias. We do some things, they work out, and we then stick to the plan because we interpret all subsequent evidence in our favor. It's very good in the ancestral environment, but terrible in an investment environment. 3, we have a crowd-following tendency. I was thinking about this the other day. You know, all the small endowment funds that decided to go into alternative investments because Yale and Harvard were doing it. Now they're all running the other way, if you read the paper. Did they get the timing right? Are they doing it right? Sometimes, but a lot of mistakes. They don't know what they're doing. They're following the crowd. To follow Malcolm Gladwell, sometimes the crowd is wise, but sometimes it's suicidally mad and we go over the cliff like lemmings. Do we know which is which? No. We don't. Fourth, the fourth deadly sin is that people tend to have excessive discounting of the future. You don't think about your longevity risk or how long you should be investing and all that kind of stuff properly. Fifth, we're insensitive to the aggregation of small costs over time. That's a point that Stephen rightly emphasized in his opening remarks. You know, what difference? Even investors in a fund like the Vanguard Mutual Fund, you can go online and look at their little charts that say, oh, if you were investing in an ordinary fund, here's how much more you would be paying than in our index funds, and how much it would hit you over 25 years until you retire. It's there. Does it affect behavior? Not really. Some people do, but fewer than you might think. We tend to just say, oh, well, yeah, it does. 10, 20,000 maybe, but the active investors will do better, won't they? Sixth deadly sin is that most people are completely incompetent at assessing probabilities properly, or much less assessing empirical studies about, is there evidence that active investing pays off? Can you assess all the empirical research or judge it? No. And 7, we have very poor understandings of the concept of risk, how best to measure it, and how to factor it into the assessment of returns over time. Most investors look at returns over a time period in relation to a benchmark. They have no idea of the importance of volatility and how important it is or isn't, and therefore they can't choose how much return per unit of risk. So what I would say, the fault, dear Stephen and John, is not in the stars, and it is not entirely in the bad guys who manage the money in the intermediary chains, but also in ourselves. As savers, as ultimate savers and individual investors, whatever. So what I think is that in order to get a really optimal, the reforms you suggest will move us in the right direction, I don't know about that. To get a really serious move towards optimality in the investment sector, we're going to have to get into some deep analyses of how to mitigate or counter all of these innate tendencies that affect both the agents who are managing our money and convincing themselves that they actually are adding value, and ourselves as ultimate savers, very few of whom are actually going to do a fully rational analysis. How do you design institutions that push us in the right way, keep people from going into stupid IRAs where they make their own investment decisions, but nevertheless don't not get tricked into inefficient big fund? That's a hard thing. There's a lot of detail to be worked out, so much more work to do, guys. I'm waiting for book 2.
Absolutely. Those are wonderful thoughts. I agree with everything that you said. I often say to my husband, you spend more time obsessing about whether this parking lot costs less than that parking lot than you do on our retirement money. And it's because it's here and you can understand it. Bob Eccles, what do you have to say about this?
So it's 5 minutes of one. People haven't had lunch. I'll make 3 quick points.
Okay.
And then save some time for Q&A.
Okay.
First, I'd like to just briefly touch on this notion of pricing structures. So we've talked about fees. John said, you've got transaction-based fees.
Could you move your mic? Thank you.
Sorry, I've got allergies. If I cough, I don't have the plague. Don't worry, I just have allergies. So it's okay. You're going to leave here alive. There's really a lot of different ways, but there's the kind of transaction-based fees, which encourage turnover that John was talking about, and then there's fees based on assets under management. And those can be pretty low, like with an ETF this morning, BlackRock came out and said it's going to charge 4 basis points, which isn't a lot. It's like 0.004%. Hedge funds have a pricing structure called 2 and 20. To make the numbers easy, say you're $1 billion hedge fund. This is one of the alternative classes that Bob was referring to. $1 billion would be a modest-sized hedge fund. That 2% means that you're getting $20 million a year to keep the lights on, okay? Kind of buy lunch and things like that. The 20% means that you get 20% of the profits that you make for the people you're managing the money for. Let's say it's a good year. Right now, hedge funds are tanking. It's a good year, you make 15%. They're looking for those kind of returns. 15% of $1 billion is $150 billion. 20% of that is $30 billion. So you've got $50 billion a year in revenues coming into a hedge fund that takes about 25 people to run, okay? Whether that's a good thing or a bad thing, we can debate, but my point is that these pricing structures are deeply embedded, and trying to change pricing structures is hard. And I think ultimately where this is going to have to come from is with the asset owners, and I think ultimately you have to go to the asset owners for this conundrum, really, that they nicely lay out in their book. If you think about any other industry, when you've got this ownership chain that they describe with 15 steps, like how did this happen? Right? Every other industry, when you see these supply chains get extended like that, there's some economic rationale, and it's done for purposes of efficiency. They nicely describe how that hasn't happened here. I'm not quite sure why. You've got the data on this. It was like, what is it about the way this industry evolved? Because these 15 steps weren't always there, but they've been added over time, and it hasn't contributed to efficiency at all. Basically the level of the fees are the same. My third point is on fiduciary duty, which Stephen talked about at the end. Most of my work in kind of reporting and fiduciary duty has been on the corporate side. But I thought what Nell said was interesting. Posner's comments about all this stuff assumes zero transaction costs and perfect information. So are these independent or deep related to each other, right? Well, I think transparency could reduce the transaction cost, could reduce the fees, right? There's this issue of fiduciary duty on the fund side around so-called environmental, social, and governance, ESG integration, sustainability, something I think a lot about. My question is really, and I'll end here, what is the fiduciary duty of fund trustees around the fees? Who is their fiduciary duty to, right? So on the corporate side, is it to the investors? Is it the corporation? Is it to both? In the case of fiduciary duty on the investor side, presumably it should be to the ultimate beneficiaries, I would think, of the people whose money is being managed. Whether the directors think that way or not, I don't know. Or do they think that their duty is to the fund or to the asset manager, and that they should be maximizing the profits of what they're doing? So let me stop there.
That's a perfect segue to the brief points I'm going to make. Then we're going to turn it over to you for Q&A, so start thinking about your questions. You ended with fiduciary duty, and that's exactly where I wanted to begin. One of the things that fascinates me about our financial system is that when we are most aware of the potential for conflicts of interest, the potential for self-dealing, the potential for diversion of funds away from where they should go, what do? We impose the fiduciary duty, which means you have to try extra hard. You have to really, as the Supreme Court said, above the morals of the marketplace, which seems a very low bar today. But you know, that's what fiduciary duty means. And we have fiduciaries throughout this system. We have fiduciaries, boards of directors are fiduciaries on behalf of shareholders. Fund trustees are fiduciaries. Now, everybody remembers a few months ago when there was a big fight on Capitol Hill, and they literally turned off the lights on the Democrats who were there to argue for better gun legislation, right? Everybody remembers what that happens. Do you remember what it was that Paul Ryan came in and passed while that was all going on? It was about the fiduciary obligation. Believe it or not, as shocking as this may seem, there's one little last place where there is the idea of fiduciary, and that is if I'm a money manager and I'm hired to come in and counsel the people that Bob Clark has just explained are not really in a good position to make smart choices about their retirement. I'm brought in to counsel them, to help them counteract all of those evolutionary biology reasons why they're going to make bad choices. So they really are dependent on me. And so the fiduciary rule now says I may not recommend my own products. I think we all understand why that is, right? I'm asking them to trust me. I'm asking them to do what's best, to believe that I'm there to do what's best for them. I can't recommend my own products. No, Paul Ryan wants to come in and say, sure, why not? Let them recommend their own products. Let the buyer beware. So we've gone from fiduciary obligation to caveat emptor. And you touch on all of that in the book, but that is something that I think is critical. Another thing you touch on in the book that I would love to see more attention on is the huge difference that has come about as we've switched over the last 20 years from pension funds that are defined benefit, meaning that you put your money in and at the end, just like Social Security, you get a benefit that's defined no matter how the market is done, to a defined contribution, which is where we have the Bob Clark problem again, where instead of having my employer with his hundreds of millions of dollars investing on my behalf, you've turned it over to me and my now compromised expert advising me and say, here, I know that your job is pipe fitting, but we're going to sit you down with a folder and we're going to ask you to give us 15 minutes later what your decision is about how to invest your money. And so I think that has a huge effect on the ability for shareholders to provide any kind of oversight to their portfolio companies, and on adding all these extra fees as well. A point that you did make really well in the book that I wish you'd had a chance to talk about more here is the difference between investing for alpha, for what is good for within the bounds of your individual portfolio, and what is better for the whole market. So that if there are overall themes like splitting the chairman and CEO, like, I'm sorry, John, executive compensation is a huge, huge issue. It is the best single predictor of bad behavior by companies when you got compensation wrong. Why do things go south at Wells Fargo? Because they said to people, we will pay you based on the number of accounts you open, not on how long those accounts stay in force, the quality of the accounts, the size of the accounts, just the numbers. Guess what? That was the exact same problem with the financial meltdown. We will pay you on the number of derivatives you issue, not on the quality of the derivatives. We will pay the ratings agencies based on the number of ratings you give, not on whether the ratings have any basis in reality. So I think that compensation is a big issue. Now I'm going to turn it over to you, and you can ask some questions. Oh, I want to mention one other thing, which is people often ask, is there an alternative? Is there anybody out there that is countering this hidden fees system? And I just want to make a plug. I have no connection with this other than I'm a customer. Former SEC Commissioner Steve Wallman set up a investment system, a money manager called Folio FN. It's a stupid name, I'm sorry. But it is completely transparent about the fees, and the fees are extremely rational. And I think it's a very clever system, very well done, and it's worth looking into. So now, questions from the audience. So you're getting a microphone.
Thank you. Name first? Is it what?
Your name first?
I'm still not 100% clear what your answer is as to the why. You know, the one question is why has the chain become so long? But the other question is why has it not gotten shorter at some point? So, you know, as an economist or political economist, my question would be why was there no competitive pressure, as you would usually expect, for people to come in earlier to offer the same product at a lower price? And now there is something like a price war going on, maybe. But the question is, index funds, for example, have been around for decades, and there have been very prominent advocates, including Paul Samuelson and so on, very early on. And yet this only really took off in the last few years. What's your hunch?
And sorry, could you say your name and
Oh yeah,
where you are?
my name is Ben Braun. I'm visiting researcher at the Center for European Studies.
Sure. Either way.
Can I just say one?
Even better. Go ahead.
No. I'll just set it up. Why is the chain? In one sense, the expansion of the chain is a reflection of the growing percentage of the adult population that's invested indirectly in equity securities. I mean, that's been going on for about 60, 70 years, fairly steadily, if you look at the numbers. And because the chain has gotten bigger and you've reached more people who are less sophisticated, you have a different level. I wrote a piece once called The 4 Stages of Capitalism, trying to identify this trend. You know, you have mutual funds, but then later on it switched. You need retirement funds to invest in the mutual funds, hopefully, or other stuff. Why has it gotten more complicated than that? Maybe because of the self-interest of the people in the middle. That's why we get the 15 parts. And maybe they can justify it by saying, well, yeah, but because now we're getting a larger share of the population, we need more advisors, more helpers, more this, more that. I don't know. But I think a lot of it is just, you know, they see the fees. So.
Let me add one other thing. I think Professor Clark has correct, but you're asking a second question, is why is there countervailing pressure against it? Since Nell is as expert in movies as she is in corporate governance, I'll use a movie analogy. The Wizard of Oz. Right? When you make things seem arcane, complex, and the regime of experts only, individuals don't look behind the curtain. Right? If it were clear, you know, that you could, we make this all very complicated. If I start talking about alpha, beta, theta, gamma, decays, right? I mean, people go, oh, I don't understand this. I don't understand how to invest. I'm just going to give it to you. And then you have a single point of sale that enables everyone to the back end. And there's no transparency of everyone to the back end. So a great example, I'm sorry the students all had to leave for their 1 o'clock class, because I know they're all John Oliver fans, right? And you should YouTube John Oliver and 401ks. Yeah. It is brilliant. And it is an example of when you start unraveling it, how many threads there are to that chain and how many people get paid. But when you make it, when people use terms like financial advisor, which has no legal definition, by the way, and a bunch of other things, people react like it's the Wizard of Oz behind the curtain. Oh, almighty, powerful Oz, they bow down and they pay whatever's given. And so I think that the industry has done a very good job of using jargon not to elucidate, but to obfuscate and to make things seem harder than they have to be. And therefore, there's not the transparency necessary and the understanding necessary to fight back.
Yeah, absolutely. Then I want to say something.
I would say that the answer is a simple one in a way, which is that no one's watching the store on behalf of those who really pay the ultimate price for this, because we haven't got systems in place that people who represent beneficiaries really make the judgments. In fact, as we've seen, there are good studies, Lauren Cohen at the business school and others have done this, looking at how mutual funds have great conflicts of interest, and very often those conflicts will affect, how where they invest, what fees they pay, how they churn stocks, things like that. It's because we don't have a real functioning system for the beneficiaries who pay the price of that to have their voice heard.
Yeah, in order to have any kind of a market response, you have to have the people making the decision have the information and the ability to act on their behalf, which has been obfuscated here. I have to tell you one story, which is that on the way to becoming one of the largest pension funds in the world is the Federal Employees Pension Fund. Federal employees switched from defined benefit to defined contribution in the early 1980s. And so they put out a request for proposal to money managers saying who would like to come in and manage this unbelievably huge amount of money. And what does the government do? They go with the lowest cost provider, right? So they did. They picked they picked an index fund, and the fees were negative basis points. How did they do that? Does anybody know?
Securities lending.
Securities lending. They were making so much money in securities lending, they could give it away to the government and pay the government to let them do it. So, a few conflicts of interest there too. All right, other questions? I saw we had one here.
So I'm actually,
Sorry.
I guess I would consider myself a pretty informed investor. I have a financial background. I worked in Wall Street. Whenever I go up, I still continue to be amazed by the sort of levels of avarice and how an ordinary investor who isn't an institutional investor, an individual investor, there really seems to be very little avenues that are available to get around this. So what are your suggestions for actions that individual investors can take, whether sophisticated or otherwise?
I'd like to see, I mentioned at the end of my remarks, I'd like to see a group in the United States similar to a group in the UK where I'm a trustee called Share Action, which really sort of steps forward to champion the interests of individuals in respect of their agents and really to advocate for accountability among their agents. But okay, short of that arising in the United States, and I hope it does, there are steps that individuals can take. One of them is to really contact, first of all, to find out as much information as you can from your agents, figure out how much you're paying in fees, find out, as Nell was saying, are your advisors covered by fiduciary duty, or do they have other interests that they are passing on to you, sometimes without your knowledge. So that's very important. If you're in a defined benefit plan, there sometimes are ways in which to vote or oust trustees of the fund, and that's a mechanism that isn't very well used. I'll just mention one other potential action that may begin to be possible going forward. I don't know if you've ever seen, and this is really a consumer concept, but there's an app called Boycott, not boycott, but Boycott. And what it is if you you can register whatever campaign you're interested in. It might be something about CEO pay. It might be GMO in food, or whatever it is, human rights. You check that off. When you go into a supermarket, you scan a product, and it will tell you what the company is, who owns that company, and how that company relates to your issue, and then gives you opportunities for raising your voice or comparing that product against another product. Now, the big question is how accurate is the information behind that. So we'll set that aside for a sec. But I can imagine a kind of a boycott process arising for funds. So you could compare one fund to the next and decide whether you should move your money if you have that ability, or raise your voice if you can.
Yes, you've been so patient.
Thanks. Joel Traxman from the Fletcher School of Law and Diplomacy. Thank you for this valuable work. I see two problems that you pointed to. One is the high price of financial services, and the other is the ability of shareholders to vote and to engage in corporate governance. And I was wondering if you would say more about the connection between those two phenomena.
I'm not sure I get the connection. I mean, part of it is, it's not so much the price, but the chain of agents and the attenuation of your ownership rights. So, for instance, if you buy an ETF because it's a low price way to invest in the market, the ETF votes your shares in the underlying companies. You don't. I actually sit on the board of a mutual fund. I have never, in 8 years of sitting on that board, received a letter from an individual saying, "What's your voting policies?" Be an interesting question. I do find that institutional investors, public pension funds, insurance companies, and those are now taking it more seriously. Our voting policies are questioned in every RFP we get. But the idea, I mean, Nell said separation of ownership and control. The idea that when you buy a share of stock, you actually are part of the governance structure of the companies that you own is not embedded in the American psyche. And that's one of the tragedies, and one of the things that Share Action does well in the UK is to say, if you own the S&P 500, you are a partial owner of Apple and GE and IBM, and you ought to care about how it's run. When you invest through a broker who then invests in a mutual fund or invests in an ETF who invests in a series of underlying stocks, you never see it, you don't know. And that's one of the problems. So it's not so much the fee structures, I think, as the attenuated sense of ownership that we get.
Well, can I just add to that? I think that, in a way, your question, there are two sides of the same coin, and it really relates to how well aligned is the agent with you as the investor. So, for instance, if we look at fee structures, you'll often find that financial agents are compensated not based on how well they do for you, but on how many other assets they accumulate. So that doesn't affect you at all, but it affects that person. So, and equally, they may get paid based on, with commissions and other fees, on making lots of transactions, therefore generating lots of transaction fees. So again, that may not really be in your interest, which is long term. In fact, one of the things that I would ask if I'm a member of a fund is the compensation for my fund manager aligned with my long-term interests? Because often that's not the case. We talk about compensation of CEOs at the corporate level, but equally there's a big issue with compensation at the fund management level. And it relates to voting because in the same way, voting is they consider it a cost center. And it's not, so agents will consider it a cost center. So that's why you would get one person responsible for 10,000 annual meetings, voting at 10,000. That doesn't make sense if you're taking it seriously as a risk.
And I'm sorry, I do have one other comment that's really disturbing about your price structure question. So 2 academic studies. Jennifer Taub at Vermont Law School has discovered that mutual funds who manage money for 401k plans, because unfortunately 401k plans generally don't have investors on assigning the choices. It's an HR administrator or some of the CFO staff. Those mutual funds are more likely than other investors to not vote for shareholder-friendly resolutions, such as splitting a chair and CEO or against the executive compensation package that's outrageous or whatever. It's compounded, though. Lauren Cohn and Brenno Schmidt found that if you're a mutual fund company managing 401k plan, you're more likely to own an overweight position in that company. And so now you've got an overweight position by funds that are least likely to be advocates for better governance. So
Jack Bogle says, yeah, exactly. I'm so happy that you mentioned that. I had it in my notes and I didn't get to it. I'm so happy that you mentioned that. Jack Bogle says that when you're managing money, there are 2 kinds of portfolio stocks. The people who are already your clients and the people you want to have as your clients. And so there are massive moral hazards, conflicts of interest, et cetera, in that. I think we've got time for one more question. Yes.
Thank you. My question is regarding who should be implementing these solutions. You spoke a little bit about logical options and a little bit about types of solutions like fiduciary duties and transparency. And we could look to the government to do these. We could look to unions of shareholders or organizations that represent shareholders. We could look to technological and market solutions. But these also might conflict. So who promises that the union won't have a conflict of interest? Who promises that technological solutions won't take another bite out of the pie? Or if we go to government solutions, how do we promise that they're efficient and not costly?
you go first. I have a list of who does what.
Yeah.
Cheat sheet.
It's a big question. It's a great question because it's really, it gets to the question, how do we fix it? You always have ideas, but, they can sit there and gather dust. The question is, how do you get it to happen? One is that within the marketplace itself, there are bodies that are making progress in this as we speak. So I mentioned share action being one, but another is the Principles for Responsible Investment, the PRI, has been now gathering more signatories. And it does require them to be, if you are a signatory, to be more attentive to some of the risks that we've talked about as an owner of shares. That only gets you a certain part of the way. Another part of the way would be the International Corporate Governance Network, the ICGN, which also represents institutional investors. And they've set out an aspirational sort of set of guidelines about what are the responsibilities of institutional investors, not just as owners of shares, but as agents. How accountable, how transparent should they be in respect of their beneficiaries? So we're seeing some new aspirational milestones that are out there, which are new, and they need to be used by ordinary people. We should ask our funds to go and apply them. But another thing is, I believe where government could play a role is in requiring these disclosure things, such as a nutrition statement that we talked about, such as a fiduciary rule that Nell has talked about. That's really important. And one thing that we talk about in the book, which I won't go into here, is how dysfunctional, in a way, our regulatory regime is today, because we don't really, it's split between the Department of Labor and the Securities and Exchange Commission, and neither of them really has a good grasp of how to move forward. But it's possible that with a new government and with such concern about Wall Street, there will be an openness to some of these, especially the disclosure requirements.
Could I?
Yep. We actually have someone who's been waiting here.
Okay.
Oh, I'm
No, you go. Why don't we take
Go
them
ahead.
and just put them all together and get the comments?
I'm IRRCi, again, I'm grateful to have been mentioned in your book. What I'm trying to do in response to your question is develop a pilot here in Boston that would float the concept of civic fiduciary, which would apply to those entities that are overseen by the state, which are all the tax-exempt institutional investors that in Suffolk County alone hold tens of billions of dollars, and as tax-exempt entities are indirectly underwritten by taxpayers. So my argument is that average citizens, even those who don't own stock, which are largely left out of these conversations entirely, and there are some real racial divides along this as well, in addition to economic divides, would have a seat at the table in terms of articulating, well, the concept would be that the institutional investors that are hospitals or museums or educational institutions should be held to a higher standard because in exchange for not paying taxes, they are allegedly advancing the public interest, and that ought to apply to their investments, which then get into all of these questions that you describe. And a lot of that information could be conveyed to average citizens, and a lot of collective action could occur around, you know, accountability. What are your policies for investment? The Attorney General could very easily, within current law, issue a request for information to all of those entities for exactly the kinds of things you're talking about. So that's one of the sort of directions in which to go that would expand the conversation to beyond just pensioners, to average people, but also look at sort of a place-based approach that is multi-portfolio, multi-asset, and so on.
Could I just finish up by saying, in response to the formal question you asked, I think it was implicit in the comments that it's very hard to do a definitive ranking of the various sources of norms and enforcers of norms, whether it's government, civic organizations, nonprofits, or even market organizations like an imaginary Consumer Reports that does financial stuff. So my take is that we have and we ought to encourage a robust but diversified portfolio of norm creating and enforcing systems, because we can't really rank them right now. Now we don't know what the ideal allocation of power is among them, but just we want experimentation, we want a lot of different sources.
And as I said, there's no one big fix. It's up to a number of places. So you have government, and the one thing I'll take issue with Professor Clark on is I do think we had some specific suggested fixes, such as changes to certain tax laws. I mentioned technology, in blockchain, but I have a meeting on Friday with a robo-advisor. These are advisors that enable you to plug your risk tolerance in, and they give you a recommended allocation. But this is one that is trying to form communities around sustainability issues and leverage. From their point of view, the communities will decrease their cost of customer acquisition. From the economy's point of view, they think that it will leverage the communities to make positive change. So their technological fixes. It's one of the positive things that institutional investors are doing lately is creating investment beliefs which enable them to sort of self-define fiduciary obligation in a way that avoids what we call the lemming standard, the if everyone's going over a cliff, we should too. So I think there's no answer of it's here. It's, as Professor Clark said, a multiplicity of norms that one encourages.
Thank you. I'll be very quick. James Shipman's my name. I'm the Executive Director on the Program on International Financial Systems here at the Law School. In a former life, I was Commissioner of the Securities and Futures Commission in Hong Kong and an investment banker, and I had just a couple of quick observations that I wanted to get your comment on. Firstly, in my career as a regulator and in banking, I never met anybody in finance who actually knew what the role of economics were, which was an earlier comment that you made. I also agree with the sort of the silence of the asset management community in trying to be a catalytic force for good. And in fact, senior leaders at asset management firms referred to investment bankers as necessary evil, but would never stand up to them because they were necessary as a consequence. And that reflects, I think, and I'd be interested in your observations, that reflects a divergence in negotiation power, and asset managers just don't have that power against what could be described as a cartel of financial services firms. And then I also wanted to pick up on the excellent point about the catalytic role of the move from defined benefit to defined contribution, and pick up on what Professor Clark was saying, and say, because of the unintended consequences of that, have we made a mistake because of the biases and putting the onus on individuals as a consequence? Have we made a mistake in that move from defined benefit to defined contribution?
I'll take the last one first because it's easy. Yes. And I would also, since my role is to look at the economy generally, I would add, not only does it risk shift to the most vulnerable population and decrease efficiency of risk shifting, but DB plans are proven to be counter-cyclical in terms of pumping money into economies. So it actually increases a boom-bust cycle in the real economy, or decreases the mitigation of the boom-bust cycle in the economy. In terms of your first one, yes, asset managers view investment bankers as necessary evil and want access to IPOs and research and a bunch of other things. But I'm not that willing to let asset managers off the hook that they're facing a force majeure situation. When they choose to come together, as they did on the Paris Climate Accords, they're able to put a lot of pressure in the room. It's much easier, though, to put pressure on governments and industry for things that are motherhood and apple pie, like climate change, than it is to look at your own business models. And so it's another reason why, in answer to the woman's question, I think you need an equalization of pressure from lots of points in this chain.
At this point, it's obligatory, to mention Citizens United and the difficulty that poses in the avalanche of money that the financial services industry spends on thwarting exactly what he's talking about.
Thank you. So many problems, I forgot a main one.
I'm sorry, you have one more question?
From a comparative perspective, how much does it take until you have an abuse of government antitrust problem? How much does it take until you have an unfair trade practice problem if you do not clarify?
We're already there. We had LIBOR fixing, we had FX fixing. We're already there.
No, I'm just trying to list some legal areas that in some other jurisdictions that have been. How much does it take, until you have a consumer protection law issues in that, or how much does it take until you have a financial agency legislation issue, or a liability issue, corporate-wise? I have not heard of any, let's say, strictly legal instruments that could come in, to be a guideline. But I'm not an expert.
There are a number of, laws depend on how they're used, right? I should defer to the legal professors here. I did serve on the Bar Association of the State of New York Committee on Corporate Law as a non-lawyer, but that's a dangerous thing to do. There are laws depend on how they're used. So the Wells Fargo case was partially brought by the Consumer Financial Product, CFPB. I always forget what it stands for, which is a new entity under, the law. The New York State Attorney General has been fairly active under, New York has something called the Martin Act in terms of looking at this. But if we are relying on enforcement action, we've already gone way too far. That's not where we should be looking for fixes. We should be looking for fixes that don't catch the bad guys, as Professor Clark said. Those are actually few and far between. We should be looking for fixes to fix what, as Stephen said, a system that's not fixed for purpose. That is not the role of enforcement. That's the role of changing the system.
I think that's it. Thank you all so much for coming. Buy some books, get them autographed.
Buy some books, more than one.
And thank you.
And I have a kind bar for anyone who missed lunch.
Can I also just thank June Casey
Yes.
and the library? It's just